continuing our series on what you should ask a lender when you are shopping for a mortgage. Down payment. How much is a down payment and what down payment is acceptable? If you qualify as a first-time home buyer, and it doesn't just mean it's your first home, it could be that it's been more than 3 years since you've owned a home. There are a couple of programs with Fannie and Freddie, and they offer as little as 3% down on a conventional loan. So 3% can be very friendly for somebody who is just starting out and maybe doesn't have a whole lot of money saved up yet. Think about your kids just getting out of college but get a really good job, just haven't saved up a whole lot, maybe have some student loans, so that's precluding them from saving a little bit. So that's one possibility for a program. FHA loans as little as 3.5% down, but there is a funding fee that you need to be aware of, or what's called upfront mortgage insurance premium. For a VA and a USDA loan, they can be as little as 0% down, but you do have to qualify. So for a veteran's loan, you need to have obviously a certificate of eligibility. You need to have served, and then you can qualify for the 0% down, assuming your debt to income ratio and residual income worksheet work out. And USDA is a whole different ballgame. That is a loan that is for rural areas, and you basically have to qualify based on income. And if you make too much, you may not qualify for that 0% down. However, you do want to ask your lender if they offer these different programs, as we said on another video, and then you would know whether or not these would even be an option for you with that particular lender. Now, if you put less than 20% down, you will have mortgage insurance, and mortgage insurance premium is something that is required by lenders. Just you have less skin in the game, and therefore it's a higher risk of a loan. And the lower your down payment, the more risk. The higher your down payment, less risk. That also shifts how much you're going to pay as far as interest rate. So with more risk, there's going to be a slightly higher interest rate. With less risk or a higher down payment, there's going to be slightly lower risk and then lower interest rate as well. The typical down payment that everyone thinks of is 20% down. And of course, if you do have that, you won't have to pay any mortgage insurance, but you don't have to have that to qualify for many loans. So I think that's encouraging to know that you don't need quite as much as you might have thought initially. I hope this content helps. If you like it, give me a like and a follow. Ask any questions in the comments. I'm loving all of those warm and fuzzy comments that I'm getting, and I hope you guys have a great day.